Good morning, everyone, and welcome back. I hope you enjoyed our first session of the day so far. It gives me great pleasure to welcome you for our next panel session, the BD Outlook, our Medtech's movers and shakers ready to resume. Well, to answer that question and several more, we have Elizabeth Cairns from Vantage moderating our next panel. I will hand you over to her shortly. Don't forget to ask questions as we go through. We'll do our best to make sure that everyone answers them and obviously make those connections with any of the speakers and panelists, either on this panel or on those as we go through the day that you want to find out more about. So Elizabeth, over to you.
Thank you. So I'm joined here by Charity Kufaas from Medtronic, Rupert Winkler from Olympus, Xavier Bertrand from Boston Scientific, and Finn Haley from Edwards Life Sciences. So the question in the title of this panel is, are Medtech's movers and shakers ready to resume? But actually, the business development environment last year was surprisingly good, considering the unprecedented challenges that everyone faced. Charity, what's your impression of how deal making was last year?
Oh, last year was such a strange year for all of us, wasn't it? It was a very year which went through different phases. I think we were out doing our normal M&A, and then obviously COVID hit, and then the lockdowns, and at that point we paused everything, as I think we were just trying to figure out what is actually happening, what's the future 3 months going to look like, and we had no ability to even project ourselves further. But very quickly, within a matter of couple of months, I think, we adapted to the new world and started to move back into execution on the M&A front. And so if I look over the whole of the year for us, we completed 7 pretty important tuck-in M&A deals for us and deployed a significant amount of capital despite COVID.
Mm-hmm. And have you seen sort of similar pictures over at Boston Scientific? There was quite a large deal just last week, I think. So things sort of picking up, the ball rolling again, coming up to the new year.
Yeah, very similar to what Charity just mentioned. After the first shock in the first half of the year, especially the first few months of the year, I think the activity resumed, and basically the last year also forced us to look back at what is our core value proposition, what do we bring to the market, where should we focus on, and also what should we be anticipating for the years to come. So when you do all of that, and as well as looking at cash, I think then you get a pretty good idea that you have opportunities out there, which was actually also for us reflected in our last activity late last year and early this year.
Mm-hmm. And Finn, how do you see the year ahead unfolding?
Yeah, maybe I'll quickly touch on 2020 and then
Sure.
Talk a little bit about how next year will unfold. We had a very similar experience at Edwards, I think, to what Charity and Xavier were describing. We came into the year working on quite a few things. And those kind of deals ran across the spectrum, looking at evaluations from M&A, early stage investments, portfolio reviews and the like. And then we had the same reaction. Everything sort of paused, and we said, okay, well, how should we respond? And what was interesting for our business, and I think maybe it's a little unique, and we've been public about talking about this, a lot of what we do is tied to elective procedures in hospitals. And there was this period of waiting where we were trying to see, okay, well, how is that going to play out? How is COVID going to impact that? And then I think we all started slowly to realize that there were various dynamics that led to opportunities in the market still. Companies that had cash, that had been disciplined in cash management, we're seeing some interesting opportunities emerge. Access to capital was starting to free up again. And it just became an environment where we started to see pockets of opportunity. So we see a lot of momentum heading into next year, actually. And some of it is that we because Edwards is very focused on structural heart disease, and we're very focused on the heart in general, we tend to be looking at things that often are earlier stage, and those markets are still very, very active in the private capital VC markets. So we think 2021 is actually going to be a very robust deal-making year. I don't know if I feel the same way about, I guess, what we call the healthcare mega deals. I think it remains to be seen what segments of M&A become really start taking off. As Charity mentioned, there was a number of companies doing a number of bolt-ons, maybe some mid-size. Will we see big deals next year? I don't know yet. Those can be complicated to do for due diligence remotely, but I think bolt-ons, mid-size, early stage, I think it's going to be a really busy year in 2021.
Now he's not unmuting. Rupert, would you agree with that assessment?
I lip read Elizabeth saying, Rupert, what do you think about that? Yeah, so again, I mean, from the 2020 experience, it was, again, very similar story. And the three things we had to do when we went on hold was, one, what does COVID mean for our own business, right? That's the first priority to work out before we start deploying cash inorganically. Secondly was, how are we going to practically do merger integration, and the third is, what does it mean for the valuations and the prospects of the businesses we're looking to acquire. So I think we were right. There was a very logical, rational reason that so many consolidators put the brakes on, and we got some deals done. Not as many as Medtronic, but we're not quite as large as Medtronic. So we got 4 done, I think, which is probably more than we would have expected when COVID first hit. Of course, we're now going into 2021, and most European countries in the US are pretty much stuck in a second, or is it third wave, that's even worse than the first one. But the situation's rather different. I think we're much better prepared for how we assess, how we analyze, how we do some of these things. And in terms of our strategic focus, it's really the same as what it was before. So I would concur that we should see some activity both across the spectrum and from Olympus specifically.
Mm-hmm. And how important is focus to a business? Are we going to see sort of trends where companies hive off the things they're perhaps slightly less interested in, and would that be a basis for more deal making in the future?
Yeah, I think, assuming that's a question for me to start with, I think all companies sensibly need to do portfolio rationalization from time to time, and it's just a sensible matter of strategic prioritization. Will we see necessarily more of that? I don't know. I don't necessarily see why we would. I think strategic focus is clearly extremely important for any business to be able to do it well. You try and do too many things, you're going to do a lot badly. And then how that also ties into some of the new emerging sectors, emerging healthcare trends, some of which I think are really already, you could say, are proven, some of which I would argue are not necessarily yet, but there seems to be a consensus that they're going to be the big thing. By definition, no one is fully focused on those yet, or is necessarily a leader in those yet. So how do you marry that with your existing strategic focus? So those are some questions that we're grappling with now.
Xavier, do you have any sort of thoughts along those lines?
Yeah, sure. I think, yes, focus will be so important in the year to come. It's always been. I think the question is, what do you define as core or to your business? That's probably what is changing a bit. I think it was probably easier to define what is your core business a few years ago than it is today. It is not only about the devices you sell, but more so how you sell them. And so that's part of your core, right? So that can trigger different type of deals like the one we just did. So I think that's probably changing a little bit the definition of focus in my view.
Mm-hmm.
Yeah, so maybe could I comment on that? I think there are a number of companies out there right now, and that probably historically had a greater emphasis on selling products. We're maybe a little shy or still thinking about how do you participate in the digital health, telehealth, AI-enabled revolution that's going on. And we've had some discussion about this where I think that the strategy of either being a fast follower or drafting off of others and seeing how that all played out was something a lot of companies were doing. Let the largest players chart that course, and then we'll all kind of fit, and others can kind of figure out how they fit into that new ecosystem. I'm not sure that change hasn't been dramatically accelerated by what we saw in the last 12 months. I don't mean to say that everyone is going to transform themselves into a telehealth company. That's not what I mean, but I think from what I hear and talking to peers across companies in the space, if people weren't weren't where they needed to be in their analyses of these new and emerging spaces, they're all hiring consultants right now or having their internal corporate strategy teams take a look at these opportunities, whether it's connected devices, telehealth, remote patient monitoring. The data is pretty unambiguous. There's a lot of capital flowing in those spaces, and as on the corporate side, companies are just looking at themselves now and figuring out, if we look at things like a patient journey, a patient experience, and in the segments that we all play in, where should we have digital data enabled solutions? And I think that's going to be interesting to see if there isn't a land grab of sorts that starts happening with the assets on the chessboard in some of these spaces. Because while there are a lot of startups, a lot of companies going up, there aren't as many that have revenue and scale already. And so, we've alluded to it, but in an area that's like ambulatory cardiac monitoring, which is something, in the space related to the heart that Edwards cares about. Lots of deals lately. Philips biotelemetry. We already talked about the Boston deal. Xavier knows well with Preventis, Hillrom buying Bardi. So they're happening really quickly all of a sudden. Mm-hmm. And it's going to be interesting to see if that trend continues.
Yes. I think just to add to that, I think the other interesting dynamic which we may see appear is new entrants, new competitors coming into this space. Not the traditional medtech, med device companies, but how far do the technology guys choose to move into this space will be interesting to watch and observe over the year ahead.
Absolutely. Okay, interesting. And telehealth is important for merger targets and business deals that way, but telecommunications also sort of vital for getting the deals done. What has virtual diligence been like across the past year? And with COVID clearly not going away, this is going to be something you're going to have to be relying on for another 6 months, maybe a year ahead too. Rupert, do you have any thoughts on that?
Yeah, so I mentioned earlier that we found we probably could do a lot more than we thought we could, and that's been hugely beneficial. And we've been a little bit creative and adaptable. We've done sort of demos, live, but there's a limit to that, of course. You can read as many quality manuals when you're diligencing as you've got time for, but eventually you've got to go in there and see how things are running, right? See how these things are being adhered to, and that's the reality of it. So if we can't do that, we can make an assessment and say, okay, we can bake in this much risk into our deal. But even then, on a PMI perspective, we've got to go in there to fix it. You can only do that on site. And similarly, I think face to face, I wonder if there's going to be a little bit of a dip in some of the sort of earlier stage pipeline sourcing, because I do think it matters. Notwithstanding, I'm saying this in a recorded conference for a virtual conference that's normally live, but it does matter to go and meet people face to face. So I think not just within BD, but within our company as a whole, we've managed successfully to do probably a lot more than we thought we could, virtually and remotely, and I think a lot of that is going to stay going forward, but it's not going to be 100%. And we are going to need to have some resumption of business as usual to be able to effectively do deals. I think, speaking for Olympus at least, that's just a reality.
So it's another thing that hinges on vaccine deployment. Once everyone's been jabbed, will there be a little flurry of deals following that? Charity, perhaps?
Yeah. Well, I don't think it necessarily hinges on the vaccines, to be honest, because we've been able to, so far at least, we've been able to juggle doing the virtual diligence and the necessary in-person and on-site diligence that we needed to do, and we haven't, fortunately, been at the point where no one is allowed, no one can travel. So there's always been, a solution. So I don't think the vaccine will therefore necessarily trigger this mini wave that you're hoping for of deals. I don't know. You have to ask my colleagues.
Okay, I'll make a quick comment on this. It's interesting. I think when I look at diligence, I've been actually very surprised by how our teams have responded and how comfortable they've gotten. In some companies, some companies have dedicated diligence teams that their sole purpose is to every day these individuals go and they do diligence on multiple transactions, and they have it very streamlined. A lot of smaller companies have maybe a hybrid where you have some people with a lot of experience and other people get pulled out of businesses to come do diligence and learn it on the fly for the first time. I've been amazed looking around and talking to colleagues at how fast everyone's adapted to doing virtual diligence. I thought it was gonna be much rockier. It's actually rockiest. Maybe this is betraying like my fact that I'm focusing on my aspect and my experience of it. I find it's really hard in our roles. I'm a raging extrovert to begin with. I need to be right with people and look them in the eyes and talk to them. And I feel that connection and all that. And it's really tough sometimes to do that remotely and to get a sense for the, be curious what other people think. Some of the cultural aspect of some companies. So, we look at a lot of things when we meet these companies for the first time. And I'm trying to get a sense for what the culture of it is as well. That part I find to be maybe slightly more difficult. You can still do it, but being on location, feeling what it's like to be at a location is a very different thing, in my experience. So yeah, that part I really miss.
I could not agree more. Actually, to your question, I think what we've learned is that, once you have the intent, you keep working on your intent and the direction that you've set. So, and we see that on multiple sides of the business, by the way, not only on this side of the business. Now, so the mechanics work, so you know how to do it. And teams have been very, very agile and creative and resilient in a way to make this diligence happen. But if we're able now to support clinical cases remotely, I think we can do diligence remotely. So it has not been our biggest challenge to deal with, I would say. Yeah. Now, having said that, I'm losing the fun part of it, and the emotional part of it, which is like part of the fun, but also, the deal is all about process and being rigorous, but there is also a bit of magic there, and that's probably less so, as you just say, Finn. If you don't meet the people eye in the eye, if you don't see some of them arguing somewhere where they were not supposed to argue, and you just pick that, and that happened to all of us, I guess. So that's more difficult to do in a very formal kind of definite square that we have on our screen. So I think we're losing something there for sure that will trigger probably smaller, earlier stage type of diligence or deals than large ventures.
Well, it sounds like all of us to some degree are in alignment that we can navigate the diligence side of things. I'm curious what all of you think about. I almost think about valuations heading into 2021 as an issue that I think is maybe going to be something that hampers some companies' ability to do deals more than the diligence process. I look at Rupert, I think it was you who made the comment earlier, you have to be disciplined. I feel like there's a lot of pressure to relax standards on whether it's, return on invested capital or hurdle rates and things, because it feels frothy to me. I won't speak for my company, but to me it does.
No,
so,
well, let's add that caveat as well. And I don't speak for my company. Maybe we have, but yeah, no question. And I think, all of us in our position have got a mandate to try and do inorganic deals that are going to support the strategy, but that shouldn't be at the cost of getting lax on price discipline. And the fact is, we are operating in an environment where, particularly in the States, valuations are getting very, very frothy. And it's very, very simple. Would you rather do that deal at what in hindsight will clearly look like an inflated valuation, and then that makes the risk of problems happening that much more acute, or just say, okay, we missed out on that one? And it's a very, very difficult judgment call. But I think when for example, well, there's this strategic value that's rather nebulous is going to have to be shoehorned in to start making the case stack together, that maybe that's an amber light flashing that needs to be addressed. So I think we're on the same page.
Charity, do you get the idea that company valuations might be militating against deal making?
Oh no, I completely concur with that. I was nodding wildly to what Finn and Rupert were saying, and that being one of the I think the biggest challenges going into this year, which I also then think kind of throws up the question of capital allocation, and to what extent do you then divert more capital to internal R&D and less to M&A when valuations are so frothy.
Yeah, that's definitely true, and I think particularly for a company like Olympus, which has got a really strong R&D heritage, so there's always going to be that really kind of strong need to make the make case very, very cogent. Sorry, the buy case very, very cogent against the make case. That's absolutely going to be the case. And I think, bankers, of course, will always find a way to justify the valuation, no matter what it is, right? It's still a steal, and that's where that kind of, internal discipline really, really matters, and I think particularly also when we're looking at areas which represent new trends, new things, it's the future. Yeah, it may be the future, but then we've got to factor in, is it the future next year, or is it the future in 5 years, or is it the future in 20 years? Or in fact, have we all got it wrong and we're looking at something that's which would not be the first time, right? In the medtech or the pharma or the life science industry generally, these mistakes do happen. So.
Well, and that's a good point. I mean, just looking at Charity and Medtronic, some of the deals that you referred to earlier, I think, are in spaces like robotics and in other digital enabled areas. It's hard. It's hard to imagine finding value in a lot of these spaces right now in 2021. And so I think you have to be willing to, Rupert's point, to put more into the synergies, and then you're sort of betting a bit on the come. And I think, that's the other thing. It's like how much of that you have to end up disclosing. And if you make a big acquisition in the space, people want to understand how you're going to justify that kind of value. And then you have to make some kind of statement, right? And you're talking about synergies and targets, and then analysts get to ask you on every phone call how you're doing against those. So it's just going to be a really delicate dance, I think, as people try to, as we've said, sort of reinvent different pieces of their business, because they're going to be bold bets. There will be some bold bets, and then it's like, how much do you go out there on a limb and commit? But I think my view, again, just speaking for me as I think we're going to try to be really disciplined too. I really do. I don't think you can play the game of trying to change your corporate standards. And if you had these targets last year, well, now it's 2021, we're going to have these targets instead. I think that's probably not the game you want to start playing. So we'll just have to see a little bit how it unfolds, but it's going to be interesting to watch.
Mm-hmm. I mean, discipline's clearly very important, but is there a case that in some situations companies can't afford to stay away from these kinds of deals. I mean, there's a huge impetus there. Xavier, perhaps you have some thoughts?
You can always, you can always afford not to do a bad choice. So I think no, valuation is super important. So even you cannot afford to have a wrong valuation. Nobody can, I think, especially in these times. So I don't think that will change dramatically. And back to what Finn just said, to me, it's not like you had this list of companies last year and then you just completed a different one this year. It cannot be that dramatic. In the last deal we did, by the way, the deal is not closed, but we have been investing in Preventis years ago. So it was not a new one on the list as far as we're concerned. So I don't think you will see a dramatic change of logic. And back to all what my colleagues just said, I think valuation is key. And I mean, nobody can afford the wrong valuation. I mean, why would that change?
Mm-hmm.
True. Okay. And one of the trends we've seen over the past year is the increasing involvement of special purpose acquisition companies. They are sort of flush with cash and are very keen to do deals. How is this going to affect the merger market in 2021? Charity, perhaps, if you have an idea on that.
Sure, and I'll let my colleagues chime in afterwards.
Certainly.
So, I mean, I think they're a very US concept, right? These entities that are created that IPO to raise significant amounts of money, blank checks to then go out and acquire assets in certain spaces, right? But they have raised a lot of money, and I think Finn said it was something like 17 billion just in kind of in the life science space that's been raised in the past, say, 15 months, right? And they have to look for assets, and they need to buy them within 2 years, or else they have to dissolve and hand the money back to the investors. So they're obviously going to be an additional competitor, going after assets. I think they'll be looking more at well-established, mature companies that already have, cash flow, which is different to a lot of what we look at, to be honest. As a medical device company, we are looking for earlier stage technologies, that will then add into our existing commercial infrastructure and roll out. And we will look at them slightly earlier stage, but I think it does, just further muddy the waters and create more competition potentially around some of the assets. But Finn, I can see you nodding, so maybe you want to add.
Yeah, I just think it's an interesting phenomenon. We had the chance to talk earlier as a group, and I think Rupert made the comment that this construct has been around for some reason. Right now, they're having their moment, right? There's a lot of these coming out, and there are a number that are backed by some fairly, I wish it not fairly, very smart investment groups. So that's maybe one thing I would distinguish is we've seen a lot of these. I can't remember in the past how much what we'd call smart money was in them, but today there is a lot. And so they tend, I have the same view, Charity, that I think they're going to be focused on later stage companies. I hope, because we tend to focus on a little earlier stage like you do. Being so focused on structural heart disease and heart failure. So I hope they don't come wading too much into our waters, but I think it remains to be seen because, again, they have that ticking clock. So we're going to be watching to see how these play out. We saw there's a lot of buzz in the market around Butterfly Network and their ultrasound and imaging technologies. They have the Gates Foundation in that, and Larry Robbins at Glenview Capital. So these are interesting folks who are looking at these spaces that we're all talking about, these telehealth, imaging, data-enabled healthcare. I think I see it the same way you do. It's one more party that could show up to the table with a lot of cash. I mean, these things end up de-SPACing with a ton of cash. So it just remains to be seen. I think it'll be another factor. It'll probably mean 21 has a flurry of deal making in these same spaces.
And Rupert?
Yeah, I just have one comment to that as well, because Finn and Sharon, you're right. It's another someone else around the table, another player around the table. I mean, let's be perfectly candid. You know, when you're in an auction situation anyway, you know, you've got that sort of heightened risk of you know, prices getting a little bit out of control. That's the purpose of the auction. I think what's going to be interesting as well, you know, in relation to SPACs is, you know, any acquirer's got to have a sort of clear thesis. You know, private equity will, you know, typically what they're very good at is hacking out cost, right? And sometimes buy and build, taking smaller entities and bashing them together, cutting out costs that larger corporates are not so good at, because it's very time consuming and intensive to do. And companies like ours, you know, usually have a sort of more commercial synergistic value, which is, you know, something fits in the portfolio or rounds it out or whatever. And it'll be interesting to see where these SPACs, you know, capitalize on that, because otherwise there's a risk that this is just a pool for money. This is somewhere there's a lot of capital going around with not so many places for a good return in the current environment. So I think we'll probably see a mix of smart ones and maybe some less so smart ones, but it's gonna come to the same thing as far as we're concerned, and what that does to the bidding process.
Mm-hmm. So if telehealth was a focus, and particularly remote cardiac monitoring, are there any other kind of hot areas that might be worth pursuing in the year ahead? I'm particularly aware that there have been several high-profile liquid biopsy deals, both investments and then sometimes very rapidly acquisitions. Is that an area to keep an eye on in the future? Xavier, perhaps?
I mean, there are multiple, I will not specifically comment on this one, but I mean, there are multiple areas for of interest as usual, I would say. And there is so much uncertainty. As we say, we are on the third wave of this COVID crisis that creates new needs. And there are so many uncertainties that, yes, there will be new opportunities and new areas of focus above and beyond what we just discussed about telehealth, etc. This one has proven itself. I mean, now it's a question of how much you make it a business model. But there are a few others that, yes, are high interest. I mean, depending on where your core is, I mean, this interest will be different. It will probably be different from all of us here because we have a slightly different core. So I'm not trying to escape the question, although I'm trying a little bit. But it's I think really it depends really of what your core is and where you want to expand.
I wonder if the problem is, Elizabeth, you mentioned liquid biopsy, which might get some slightly blank looks, because, you know, although diagnostics is usually grouped under medtech, you know, liquid biopsy is pure DX, and let's be honest, they're slightly different beasts. It is obviously relevant to us at Olympus. I think we had consultants telling us, you know, 20 years ago, this is imminently going to destroy your GI business, and it didn't. But you know, these are the things, of course, we have to be very alive to, and that one in particular, and see how, you know, what our exposure to it would be, both positively and negatively. And the other one, I think Finn talked about it earlier. I mean, there's a few, and charity, you know, surgical robotics is one, and AI, of course, is the other, and telemedicine is one that was talked about earlier. So I think there's a number of sort of potential mega trends that you know, it sort of behoves us to work out what's the sort of what's the underlying reality of some of these, you know, piercing through all the kind of buzzwords and working out what the real commercial models are, and which directions things really are moving in. And it's difficult because there's a bit of crystal ball gazing involved in that.
And to this point, maybe just to come back on the question, I would agree also that, you know, you're always tempted to look at the new stuff that because it's kind of a new entrant or it's going to jeopardize your core business, like the one you just took as an example. I don't think that's a good rationale for a deal. I mean, just avoiding to be disrupted because we just spoke about valuation. This is most of the time an assumption or an assumption or an assumption, and the ROI in this type of valuation is very inaccurate. Let's call it this way. So you rather invest where you think you are going to improve, augment, accelerate your core value, rather than trying to avoid something bad to happen to your core value. From a valuation standpoint, at least in my experience, it's always worked better.
Okay, and there was some discussion earlier about the sort of different environments on the other side of the Atlantic. SPACs are very more active in the US, but it seems like an awful lot of other aspects of business development are happening more in the States than in Europe. The IPO market is more alive there. I mean, do you view companies differently based, on where their headquarters are? Are you more interested in companies based in particular areas? Finn?
In short, no, we don't. We currently don't set out. I think right now we're not targeting certain regions for any reason. I guess the reasons you might would be, are there pockets of value somewhere around the world that maybe you don't see in the U.S.? I think my view is that we should largely be agnostic, and where we spend time is where the innovation's happening. So I think some of my colleagues mentioned earlier that we all come from businesses that are fairly innovative and pride ourselves on having robust innovation engines to begin with. So we're all technology focused to some degree, I think, when I look across this panel and think about the products and solutions we have. And so we go to where the innovation is. I'm sure most of us have some presence, for example, in Israel, just because a ton of medical device innovation happens in Israel. There are pockets all across Europe that we spend a lot of time, and we try to have people on the ground, basically feeding all that information back. We are fairly agnostic right now, and when I think through the projects we have going, it's fairly spread across the globe. I mean, there's maybe a slight bias to the U.S., but it's not that meaningful. So I think that we're going to approach it from, and this was something that Xavier said, we all have to look at what we're good at. And I think it's true that in my experience, Edwards has been one of the things I think we've been very disciplined about is maintaining a focus, and we want to play in sectors where we believe we have a path to leadership. I'm sure most of us on this panel feel that way. If you don't have a path to leadership, you probably shouldn't be going into someplace. And so we want to identify what technologies we believe enable that. And when you find something that makes sense, and you've done the work, and you say, listen, if we marry this with this ability we have, or this internal R&D project we have, we think we have a path to be the first, second in a market. I think then you'll see companies continue to be aggressive, right? But I don't think we're going to say, things are expensive in the US. Everyone's doing AI. Let me go find an AI company in Europe. I know that no one's suggesting that, but I don't think we're going to be playing that game. We're going to be like, what's the best technology for the space we want to be in? And wherever it is, let's go find it and see if we can make something happen. That's the way we think about it.
Sure.
I completely agree
Charity
with
was digital surgery because it's in Europe, or because it was
so and Medicare as well. I was going to say I completely agree with with Finn, and I'm sure all my colleagues, right? We go where the technology is. The one exception, that I will throw up, and I'm curious to hear their perspective, is certain countries we're starting to see some more protectionist moves, where they are, from a commercial perspective, giving business advantage to local companies. That tends to be in the more well-established medical devices. If I look at China, or if I look at Russia, they're all now in their tenders bringing forward these systems which give preference, additional points if you are a local manufacturer. And so I think that those are the situations where we might contemplate thinking about the geographic location of a potential acquisition target, because it gives us that commercial opportunity.
Yeah, fully agree. But then it comes back to valuation. I mean, if you then valuation has to stick basically to be in sync with the market you're targeting. If it's just for a given region, pick Russia, a great country, but I mean that's just Russia. Then that you're, if you're localizing, the valuation has to go with the potential. So that's kind of a give and take, I guess, right? Maybe just one word is that I think I completely agree with my colleagues here. The deal was, I would just summarizing like, M&A will remain global, wherever the good technology is located is not really the problem or the opportunity. I mean, you just take it where it is. I think we'll probably see more local or regional partnerships, because here we've been talking about M&A only, but I mean, I also believe that with what we're going through, I mean, all of us, I'm sure, are looking at partnerships, and probably here you'll see some more regionalization to actually deal with the agility and the speed of change that is somewhat different by region. So probably something to keep in mind as well. It's not all M&A.
Sure. I mean, the Medtech has traditionally been sort of more into M&A, less licensing and partnerships than biopharma, but is that something that's going to change in the year ahead? And is COVID playing into that, or was that kind of trend always going to appear?
Speaking just for me, and just by the way, to expand on Xavier's last point and charities as well, I think when we talk about geography and M&A, if we're talking about technology, then I think we can all agree it's pretty agnostic, whether it's Israel, as Finn said, is a good hub, or a lot of European countries, or the United States. Obviously, if you're looking for sorts of regional channel in Latin America, then it's going to be very site specific. As give another example where geography does matter. But I would also add where I do think, for example, in Israel, it's very common to find good technology. It's very rare to find really mature commercial stage businesses that have really proven out on that ramp. And I'd say it's much more common to find that sort of business in the US than it is anywhere else in the world. So I do think that's a bias in favor of the US. In answer to your question about other types of deal, and I don't know how many of my colleagues do stuff other than M&A within their teams. I know Finn said you do all of it, and I guess we do, and I'm sure it's true for the others as well. I think, there are reasons that licensing lends itself well for biopharma products in a way that often it doesn't lend itself so well to medtech products. Having said that, sometimes a distribution deal can almost have the characteristics of a licensing, depending on how it's structured, depending on what sort of protections and breaks are put in place. So it can get a little bit semantic, but I think we agree the point that distribution is fundamentally a different thing to licensing. Where I think medtech companies probably will need to get a lot more used to licensing in the way that biopharma and pharma companies are, is of course in the technology stuff around software and things like that. And as you move maybe from a model that sells widgets to a model which sells subscriptions, then I think the deal, the deal shape has to change with that. I mean, if you're talking about a company that you want to partner with, whose fundamental model is to place some capital and have a subscription where software, AI for example, is continually upgraded, then obviously a classic distribution with minimums and all the rest doesn't necessarily fit that model so easily. So I think it is relevant there.
Okay, we are pretty much out of time, so perhaps another quick comment from Finn, if you just wanted to say something very briefly.
No, sure. I was just going to say I completely agree with everything Rupert said, and I think we're going to see a lot more creativity. And I was going to give a little tip of my cap to Charity and the team at Medtronic, because I know they had done a creative structure around with Blackstone around R&D funding for their diabetes platform. And I think we're going to see all sorts of creative ways to unlock value beyond traditional M&A that our teams in strategy, business development, and corporate development are going to be tasked to do going forward. So I could, if we had more time, I'd love Charity's view, but maybe she and I will talk about that at a later time, because I thought that was a really interesting transaction we did.
Okay, well, thank you all very much. That was fascinating as always, and perhaps ended a little too soon, but very enjoyable. Thanks, everyone.
Thank you.
Thank you so much, Elizabeth, and thank you to everyone on the panel. I mean, as Elizabeth said, 45 minutes always goes so quickly. And, Finn, Charity, yes, please do chat about, anything out of today's discussion. And to everyone watching the panel, please do connect with the panelists, connect with each other on the platform. That is, after all, the reason that we're here at World Congress today. A brief break now for 10 or so minutes before we come back for our next session at 12 o'clock. We have a case study around making digital therapeutics work, 10 principles to drive patient engagement. So I will see you back here very shortly for that. But in the meantime, have a break, enjoy yourselves, and I'll see you back here soon.